What's going on, everyone? This is Ben Zogby with HighStrike Trading, and today we're going to be talking about time decay, what it is, and how to avoid it when you're trading options. So what is time decay? Time decay is something that continuously sucks the value out of options on the buyer side. So think about it this way. If you're betting on a basketball game and you're betting that the Celtics will beat the Cavs and the Celtics are down by 10 points, right? That bet is worth a certain amount of money with 1 quarter left in the basketball game. Right, and so let's just say I bet $50 on 3-to-1 odds that the Celtics are going to come back and beat the Cavs. So bet $50, make $150. That bet will continue going further out of my favor as the game progresses. So if there's 5 minutes left in the game and the Celtics are still down by 10 points, the score hasn't necessarily changed at all, but there's still a lower chance that the Celtics will come back because they have less time to come back. Same thing with the stock. If you're betting that the price of Apple goes above $300 per share and it's currently at $290 per share, that bet is a lot different whether there's 10 days left before the expiration date or 1 day left before the expiration date. So the concept of time decay is the sucking of value out of that option as time progresses and the stock doesn't get any closer to the strike price, or it doesn't go fast enough towards the strike price in order to break even. So how do we get around this potentially losing game of trading out of the money options where your time decay is going to suck value out of the option as you get closer to expiration date? So there's a few ways you can get around it. One is by choosing strategic options that have a lower value for time decay that are going to lose money slower. Or two is to trade options faster at a faster pace so that you're minimizing the time that that option actually has to decay from the time you're opening the position to the time you're closing your position. So let's hop into my phone really quick. I'm just going to make a nice illustration here for time decay. So we have our expiration date here. And for those of you guys that don't know what an expiration date is, it's literally just the day that that option expires. It's like buying insurance and saying this insurance is good through December 31st. And so December 31st is the expiration date on that option. So we have our expiration date right here. And let's just draw our break-even line in this nice, pretty purpley blue color like this. And so the break-even line is the line that you need the stock price to reach in order for your option to be worth the amount that you paid for it at expiration. I'll say that again. The break-even price for an option is just the price that that option has to reach in order for that option value to be the same as it was when you paid for it at expiration, okay? So let's say you bought down here at this little X. You would need the stock price in general to move something like this in order for you to break even, right? So as the time is progressing, that line is pretty steep and you need the stock price to stay at or above that line in order for your option at current time to be worth what you paid for it at the time of the X. So potential stock price movement here. So if your stock is moving like this, right, you are going in the correct direction towards your strike price, but we're not moving fast enough, right? So that option, even though we are going in the correct direction, is losing value. So how do we take this information and process it and make sure that we're trading options that aren't going to be death traps for us? The first way, guys, is to simply look at the theta value. So if you're looking at the Greeks, the theta value, it looks like this, or it might just say theta. The theta value is the amount of value that the option contract loses per 24 hours of passing time if no other variables change. So obviously variables do change like volatility and price. Those aren't what we're concerned with right now. But if you're looking for an option that's going to retain its value very well, you want to look for a low theta value relative to the value of the option. All right, so if your option is potentially priced at $6 and your theta value is 0.08, so in this case, that is a pretty relatively low theta value. Now, there's no exact definition for what a low and what a high theta value is. You just have to look at what the theta value is, compare it to the overall price of the option, and determine whether or not that's worth it for you in terms of maybe that being too much time decay for you to want to get into that option. So options with a lower theta value are typically going to have break-even lines that look more like this. All right, so in this case, we need the stock to put in a lot less legwork to get to a break-even price than we would for a stock with a really high theta value that looks something like this, where we have virtually no chance of breaking even. So that's the first way, guys, to make sure that time decay isn't killing our position. Look for options positions where your break-even line is relatively flat and that theta value is relatively low compared to the value of the option. Another great, awesome way, guys, to avoid time decay is to trade options quickly. So I know a lot of you guys are not weekly options traders, but if you are, you might want to consider trading options in a shorter time period. So again, guys, I'm going to draw my expiration date here. So again, guys, I'm going to draw my expiration date right here. And so for an option, guys, instead of drawing the stock price in this case, I'm going to draw the option value as we progress towards time. So typically time decay looks something like this. The closer to the expiration date you are, the faster value is sucked out of the option, because the lower and lower chance you have exponentially grows as you progress towards the end of that expiration date. If there's 1 minute left in the basketball game that we were talking about that you're betting on, and the Celtics really have no chance of catching up and winning the game, that value of the bet goes exponentially down, because there's just no chance that it's ever gonna, reach the break-even point. So now let's look at where we want to be targeting our option buys in this window, so that we're minimizing the amount of time decay that we lose, right? So let's just pick a few different points. So we have each day of the week. So Monday, Tuesday, Wednesday, Thursday, Friday. So this is the last week before the option decays fully and becomes worth nothing. So if you want to trade this option, when is the best time to do it? If you're looking to hold for about a day, it's Monday to Tuesday, right? Because the drop in value for that option is the least compared to the time that it's open. All right? And so the worst time to buy the option would be on Friday, when there's absolutely no chance of it actually reaching expiration, and you just see the value being sucked out of that option extremely fast. And there's virtually no chance that you're going to make money on the option. All right. So then another way, guys, besides looking at the theta value and comparing it to option price, is to actually look at where you're buying that option in relativity to the expiration date. So if you are getting in and out of a position in a few minutes, that's a very minimal decay in the option value, because you're not holding on for so long, and you're not giving the option a chance to actually decay in value, because the theta value isn't high enough to suck value out of your option in the 2 or 3 minutes that you hold it for. So I realize this strategy isn't very practical for people that aren't options day traders or aren't weekly options traders, but it is something to think about if you're, maybe spreading this time frame out a little wider, and instead of each of these being days, maybe they're each weeks, and you want to swing an option 5 weeks out, minimize the theta value instead of trading it in the last week, right? And having that theta value be extremely high. And guys, the last way that I'm going to show you real quick and briefly about how to minimize time decay on an option is by trading multiple options called spread. So when you buy a spread, it's a combination of at least one call with at least one put. So the first way to buy a spread is just to buy a simple straddle. This is what your break-even price looks like on a straddle, with the green line vertically here being the current stock price. So when you buy a call that's out of the money and a put that's out of the money, you make money when the stock moves either in the upwards direction or the downwards direction. But you don't make any money if the stock stays where it is and neither of those break-even lines are hit. But you do get to minimize your losses, right? So on any straddle that you trade, the maximum amount of money that you can lose is the amount that you pay upfront for the straddle. And that's where we bottom out here. That's the maximum amount of money right here that you can lose for trading the strangle. And you can see, guys, on the upswing and downswing, and you can see here on the upswing and on the downswing, you have unlimited gain in either direction. Obviously, on the put side, you can only make as much money as the stock has room to go down. But in this case, guys, you want to make sure that your opportunity for profit on the upside or the downside greatly outweighs the amount of potential risk you have. And the amount of potential risk is the total amount of money that you paid for those options. So say you paid $50 for the call and $50 for the put. The maximum amount of money that you're going to lose in this trade is negative $100. But if you go on the upside, and I'm just estimating here, maybe the max feasible amount you make on the upside is plus 200. And maybe the max amount you make on the downside is plus 200 as well. Now you would only need to win this trade 33% of the time for that to be a break-even winning rate. Obviously, we want to win more than that. And if we can do that, then, hey, you found a profitable trading options. And if you can win more than that, then, hey, you found a profitable options spread strategy. But the main idea here, guys, is that time decay in this case, is less of a factor, because you're bringing everything down to a science in terms of where the stock price needs to be at expiration. And you can take in all of that information up front and not have to worry about time sucking the value out of your option. Even though time decay will be working, the max amount that you can lose is only the amount that you paid for those options. So that's my awesome video on time decay. Hope you guys enjoyed that. I gave you guys 3 awesome tips for making sure that time decay doesn't take all of your chances of winning an option out of the picture. I hope that I earned your thumbs up in this video, provide you guys with some value. If you haven't yet, if you're new to the channel, please subscribe, and I'll see you guys in the next video.